Hi, I'm Bill Wilt of Assured Research. Thanks so much for joining this video drawn from our September Assured briefing on workers' compensation. And the title of this note is that we're raising a yellow flag on workers' compensation margins and reserves. So workers' compensation, as anybody listening will surely know, is one of the most consequential commercial insurance lines. It's been an absolute profit juggernaut over the last really several years. Just for the last 3 years, for instance, the annual combined ratio has calendar year combined ratio has averaged 85%, and that's the combination of a roughly 100% accident year combined ratio for lots of companies, and about 14 points of favorable reserve development. So why the yellow flag? And I should mention too that we are bullish on organic demand for workers' compensation, a bit separate and apart from the subject of this note, but low unemployment, increasing likelihood of a soft economic landing, reshoring trends, green energy trends, good news underlying, we think, the organic demand for workers' comp. But yellow flag on margins and reserves. Why? Medical inflation, and that's really the underlying focus of this. The underlying focus of this note. We're focused on a reconstituted medical trend, which is informed by weights for medical services, hospital services, inpatient, outpatient, prescription drugs, etc., physical medicine, weights that are informed by work done by the NCCI, and thank you to them for that. We'll show you the rising reconstituted medical trend. And also the gap, shrinking gap, narrowing gap between wage inflation and the medical trend. That's really consequential. The fact that there's been about a 2-point gap for the last several years has been very beneficial to the margins of workers' compensation insurers. Reserves, medical inflation rises, it's going to eat into reserve adequacy. I should say it'll likely eat into what we believe are meaningful reserve redundancies. So we don't, to be clear, anticipate any adverse development anytime soon in workers' compensation. But insofar as lots of folks now that we've had going on 10 years of favorable reserve development, to the extent that that starts to diminish, perhaps rapidly, as and if medical inflation continues to rise, that'll catch people's attention. And the last point before we jump to the slides, I'll just note, based on information and belief, we like to say, which is to say some basic channel checking, but we don't suggest that this our assertion would rise to any level of research or statistical credibility yet. But it sure does seem like the decades-long benefit to workers' compensation and to claimants from the reduction in opioid prescriptions feels like that's getting into the 8th inning. So that's been a really nice tailwind for workers' compensation insurers, a fundamental positive for society. Feels like that's, as we say, in the 8th inning, subject to doing more work and kind of demonstrating that. So allow me to share slides, and we'll get right to it. Good. Allow me to go back here. Okay, so again, drawn from our September Assured briefing. And if you're a subscriber, you'll have it. If you're not and you're seeing this, reach out to us and we'll happily share it as part of a trial. So raising a yellow flag on margins. Why? On the right-hand side, rising medical costs. Now, on the left-hand side, we show the medical CPI through July 2023, and we're recording this in mid-August of 2023, by the way. The medical CPI, it's a combination of volatile, and it includes a number of series with weightings that just make it less relevant than some might understand for the medical trends likely to be experienced by property casualty insurers. It includes dental services. It includes physician reimbursement rates at Medicare and Medicaid rates, neither of which are relevant for for P&C insurers. When we look at the right-hand side, and it shows across the bottom the weightings that we're using in this reconstituted medical index. You see the weightings for physicians, outpatients, and these are typically producer price index series, which I think we think more closely mirrors the weights that kind of the business to business rate. So concerning news is that it's rising fairly steadily. Two observations though: the medical CPI still in the main, really it's rising off very low levels. So it was just 1 and 2% pre-pandemic. Now you might say it's more like between 2 and 3%. Had a very favorable or a favorable downtick in July of 2023. Whether that's the start of a trend or just a one-time downtick remains to be seen. But medical trends rising. Another reason for raising the yellow flag on workers' compensation margins is that workers' comp insurers have benefited nicely over the last several years by this wage medical inflation gap. So many here will know that workers' compensation premiums are a function of payroll times a rate. Well, if payroll is going up fast and is going up faster than medical inflation, remembering that medical costs are about anywhere from, call it 55 to 60% or so of total loss payments, being indemnity plus medical. Well, if wage inflation and which in turn meaningfully influences premium, if that's going up faster than medical inflation, there's an implicit benefit to insurers' margins. But as that gap narrows, that benefit diminishes, and we see on the right-hand side the gap has been narrowing the last several months. It was averaged a little over 2%, or 2 points, I should say, 2 percentage points from 2016 into early 2023, and for the last 4 or 5 or 6 months, it's been more like 1 point. Again, still favorable, but the favorability is diminishing. And in this next slide, we give you some realistic examples, at least we think realistic examples of what happens when medical costs start to inflate faster than wage costs. So a lot of numbers here. Let's just focus on the ones that are highlighted. On the left-hand side is the base case scenario, and these are very, we think, realistic examples of what a mid-sized construction firm might pay. Our selections were informed by Market Stance, the Verisk business division. So base case, a company with 10 million of payroll pays 2.4% of rate on that. 240,000 of premiums are collected, booked at a 99.1 combined ratio. At the margins you see there, the expense ratios and expense and loss ratios you see there. Modest underwriting profit. Now, when wage exceeds medical, in the middle scenario, wage 5%, medical 3%, we inflate everything forward, assuming that that medical costs are about 60% of total losses. You can see that 99.1 combined ratio, without the insurer doing anything, becomes a 98.2 combined ratio. Now, insurers haven't not been doing anything. They've been on balance slightly lowering their rates for the last several years. And doing some math, we show here that, in this case, the insurer could have, with a wage at 5%, medical at 3%, the insurer could have lowered its rates by almost 1 percentage point, 0.9 points, and kept the margin unchanged. In this case, we show a scenario where they didn't. The margin, accident year combined ratio, shrank slightly. But now in the example on the right-hand side, when wage is inflating at 3% and therefore premiums at 3%, but medical costs, a meaningful expense for workers' compensation insurers, when that's inflating at 5%, no surprise, the accident year combined ratio increases to 99.9% in this case. And here, to get back to that 99.1, the insurer would actually have to raise their rates by 0.8 points, just under a percentage points. This slide shows what's been happening since 2016. Wage, the red line, has been growing faster than medical expenses, the blue line, and workers' compensation insurers have been on balance lowering their rates over this time frame by kind of 1 or 2 percentage points. And this kind of explains why workers' compensation insurers, as they move forward year after year, have kind of lowered rates very slightly and kept their accident year combined ratios around 100%, maybe a little bit below, and really feasted on reserve developments. And so reserve developments is part two of this note on raising a yellow flag. This shows an analysis from our year-end 2022 reserve analysis. Just take away from this that in this analysis of workers' compensation loss trends, the green reflects that things are good or cool or they, loss trends are favorable, I should say. And some of the text here is interesting. Workers' compensation development over the last or since 2012, which is reserves have developed favorably every year since then, has been incredibly $63 billion, so about 10 loss ratio points over those 11 years. And as I say, for the last 3 years, it's averaged 14 percentage points of premium. So to the extent, and maybe tying this to medical inflation more tightly, to the extent that medical inflation continues to accelerate, if it does continue to accelerate, and we think it might, that'll eat into this reserve redundancy. So we estimated 11 billion at year end 2022 reserve redundancy. Notably, that was down from about a six for us, about a $16 billion reserve redundancy, but we used a technique to explicitly factor in an additional point of inflation that we didn't think was contemplated in the loss development factors. That effort knocked off about 5 billion off our estimate of reserve redundancy. The NCCI's estimate was at $17 billion. The concern isn't that reserves are going to develop adversely anytime soon, just that the amount of favorable development may diminish as and if medical costs continue to rise. So with that, let me stop sharing and get back to seeing you. Thank you. We appreciate your time. I'll mention that for the top 25 workers' compensation insurers, reserve releases alone over the last 3 years have been about a little under 10% of pre-tax statutory income. And if you kind of look at some of the major companies and use a median rather than a weighted average, that number is closer to 18% at a lot of insurers. So workers' compensation matters, medical trends matter, and we'll be watching very closely that gap between wage inflation and medical inflation, and trying to use that as a proxy for what could happen with workers' compensation margins. If you'd like to learn more, reach out to us, please, and we'll be happy to start you on a trial to our work if you're not a subscriber. Thanks again.